When extreme weather hits in January and route volumes drop, Wall Street usually expects a company to slash its headcount to protect margins. But in their first quarter earnings call, Rollins leadership admitted they did the exact opposite. They took the financial hit. They kept their technicians on the payroll. And according to their CFO, that bet paid off massively when the spring season exploded in March, helping them exit the quarter with over 8% organic growth. Welcome to Pest Control Unlocked. I'm your host, Konstantin Schwartz. Today, we're taking a standalone look at the newly released Q1 2026 financial results and earnings call from Rollins. This quarter is a masterclass in the tension between short-term margin pressures and long-term operational readiness. We are going to unpack their top-line revenue, dig into exactly why their gross margins took a hit, explain the deliberate strategy that crushed their Q1 cash flow, and look at why their recent M&A moves are about much more than just buying route density. Let's start from the 30,000-foot view. For the first quarter, Rollins reported total revenues of $906 million, which is a highly impressive 10.2% increase over Q1 of last year. But as always, we want to strip out the acquisitions and look at organic growth. Rollins delivered organic revenue growth of 6.6% for the quarter. If you stop listening here, it looks like a solid, predictable quarter. But the real story is how they got there. January and February were incredibly soft due to unfavorable weather. But then the dam broke. Rollins exited the quarter with approximately 12% total growth and over 8% organic growth in the month of March alone. On the residential side, organic growth spiked to over 7% in March. Spring sprung quickly, and because Rollins had the trucks and their technicians ready, they captured the demand perfectly. Now, let's get into the weeds of profitability. Rollins reported a gross profit margin of 50.8%, which is a decrease of 60 basis points compared to last year. Whenever margins drop, analysts start asking questions. But Rollins CFO Ken Krause provided a highly detailed breakdown. Here's exactly what hit their margins. 50 basis points came from lower vehicle gains on the sale of fleet assets. 30 basis points came from higher insurance and claims activity. 20 basis points came directly from service payroll costs. Now, let's focus on the last point. That 20 basis point hit is not a failure. It was a deliberate operational choice. Rollins actively chose to carry more technicians through the slow winter months so they wouldn't have to scramble to hire and train a massive wave of rookies when peak season hit in March. As CEO Jerry Galhoff noted, extreme swings in hiring activity drive turnover higher and hurt the customer experience. For the operators listening, taking a short-term hit on service payroll in Q1 to ensure you have highly trained, retained technicians for the spring rush is exactly how you protect your route density and maximize lifetime customer value. Now, if you only skim the headlines of this earnings release, you might see a number that should get your attention. Free cash flow dropped by 20.6% compared to last year. But when you dig into the balance sheet, you find out exactly why. Rollins took a massive $40 million hit to their cash flow this quarter, specifically due to the timing of tax payments. This wasn't an accounting error or a surprise bill. CFO Ken Krause explained that this is part of a deliberate tax credit planning strategy. They're intentionally front-loading these tax payments in the first half of the year, and the strategy is working. It helped drive their effective tax rate down to an incredibly efficient 21.3% for the quarter. It is another example of taking a short-term hit, this time on the cash flow statement, to set the business up for long-term optimization. Krause explicitly told analysts that by Q4, we will see a nice improvement in the use of cash as the strategy reaches its full potential. You cannot review a Rollins quarter without talking about their roll-up strategy. In Q1, the company invested $18 million in acquisitions. But the major news actually closed in April with the acquisition of Romex Pest Control, a PCT top 40 company. On paper, Romex gives Rollins dense route entry points into new complementary markets while allowing the acquired team to expand service offerings. But on the earnings call, CEO Jerry Galhoff highlighted something even more important than route density: culture and talent. He noted that Romex aligns closely with Rollins in how they treat people and how they approach customer service. In a labor-constrained market, M&A isn't just about buying a book of business. It's a vital talent acquisition strategy. Galhoff explicitly stated that adding these brands brings in super talented people who ultimately help shape the parent company. When Rollins buys a company like Romex, they're acquiring proven local leadership that already knows how to retain both technicians and customers. We know that the U.S. structural pest control market is an approximately $13 billion industry, currently serviced by around 17,000 active independent operators. Rollins is aggressively hunting in this massive pool. Management expects A to continue to contribute 2 to 3% of their total revenue growth throughout 2026. They aren't just buying revenue, they're systematically sweeping up the highest quality independents that fit their cultural mold to pack their existing geographic footprint. Let's look at where Rollins is placing its bet for future organic growth. First, the commercial sector. Rollins delivered 7.7 organic growth in commercial pest control in Q1. How are they doing it? By putting feet on the street. Rollins entered this year with nearly 80 more commercial account sales managers than they had in the first quarter of last year. Those upfront investments in payroll are now putting recurring commercial wins on the board across national and local verticals. Second, the cross-sell. Termite and ancillary services grew by 13.5% in total, with organic growth nearing 10%. Rollins refers to this as having 9 shots on goal when they get to a customer's house. They recently moved Ed Donahue, a veteran Orkin sales leader, over to their non-Orkin regional brands to teach them how to leverage in-house financing and drive bigger ticket ancillary services. When you combine a 7% organic growth rate in residential with nearly 10% organic growth in ancillary services, you're building an incredibly sticky, high-revenue customer base. So what is the grand takeaway from Rollins Q1 2026? It's a story of operational patience. Rollins took the margin hit in January and February. They swallowed the insurance costs and the dead weight of winter payroll. They took a $40 million hit to their cash flow to optimize the tax rate. But because they held the line and kept their technicians in the trucks, they were perfectly positioned to capture a massive wave of demand in March. They're pricing ahead of inflation at 3 to 4%. Their commercial sales team is heavily staffed, and they're acquiring high-quality, culturally aligned talent like Romex to fuel the engine. For the independent operators out there, take a page out of Rollins' playbook. Do not sacrifice your spring readiness to save a few dollars on winter payroll. Keep your people, build your route density, and get ready for the peak. That wraps up our analysis for Rollins' Q1 results. By next week, we will have the data from Ecolab. This is Pest Control Unlocked. My name is Konstantin Schwartz. Thank you for listening.